everybody. Reporting to you again from the Glamour City, Hollywood.
I think what we're really focused on and have been for some time is where are the friction points in the system? Like, are you a collaborator with a managed care company, or are you kind of out of the gates adversarial? And like, that's just not a winning strategy for building scale. Same thing with a hospital system, or same thing for pharma. There's plenty of opportunities to make it a win for everybody, whether you're lowering healthcare costs, you're increasing efficiency, or you're accelerating drug development timelines. Like, those are wins for everybody.
If you love listening to this show, please consider giving a rating and a review on Amazon Alexa or wherever you listen. We want to continue bringing you this amazing content, and part of our ability to do that means that we need a big audience. Now, it may not seem like much, but rating and reviewing the show will help more people find us, just like how you found this show. Simply on any podcast platform, search for our show, scroll down to the bottom, and push 5 stars. It's that easy. Thanks for supporting the show. Today, I'm joined by Andrew Adams, a co-founder and managing partner of Oak HCFT. Welcome to the show today.
Thanks, Scott, and thanks for having me.
So, Andrew, what does HC and FT stand for? I think it stands for healthcare and fintech. Why healthcare and fintech?
So we've been investing in healthcare and fintech now for many decades. So far back on the fintech side to where, the term really wasn't in existence. But it's certainly been many decades of change and evolution. And one of the original attractions to both of these categories are, these are big markets. So as an investor, you always like big markets. And big markets have, oftentimes kind of big problems and big challenges that need to be solved. Certainly healthcare and fintech are no exception to that. You have well-established, very large stakeholders, whether on the healthcare side, it's a hospital system or a managed care company, on the fintech side, a bank or an insurance company. And there's just a need for constant change. There's a need for efficiency, business models changes, priorities change, growth models change, and that creates a real opportunity for technology-driven solutions to, be a growth driver for those enterprises or be a change agent for efficiency. And so that's kind of led us these markets. As an investor, we also like the fact that they are, kind of regulated with a lot of nuance. So you have to be really deep in these two areas to be successful investors over the long term.
So I actually really like the way you described this. And in some ways, not being so diplomatic, is that these are two dinosaurs. And because that they are slow to adopt, and frankly, they in many ways are not as competitive because of kind of almost an oligopoly type of a nature. And then when you compound that with the regulatory and the compliance aspects, it becomes very cumbersome, very difficult to navigate those changes. So the threshold for entrance and success is very high. But before we get into some of the details of some of the investments you've made, as well as the exits you've had, tell us broadly about Oak HCFT.
Sure. So we were founded, myself and my two co-founders, Annie Lamont and Patricia Kemp. We founded the firm in 2014. We had been working together for the prior 15 years at a predecessor firm, working on healthcare and fintech transactions. In 2014, we spun out and founded Oak HCFT to just go deeper and broader in these two categories where we'd been investing in some time. And job one for us was to build out a team beyond the three of us. So since founding in 2014 to today, we've built, an incredible team of folks on the investment side and just the firm in general, reaching almost 50 strong. And our goal is to just go broader and deeper in these two categories. And folks that join our team come from other leading VCs, from private equity firms, growth equity firms, from operating backgrounds. Everyone knows what great looks like. So they've been in a firm, they've worked with great entrepreneurs, they've been associated with great companies, they've worked for great companies, on the operating side. And that's really the standard by which we deploy our capital and evaluate new opportunities. So, we think of ourselves very much like a growth company. We've now raised 5 funds, our last being about $2 billion. And we're very active in these markets and will continue to be.
So my understanding is that your firm focuses on value-based care, primary care, and automation healthcare. And certainly some of the startups that, that I've seen over the years in this area, they, one of the biggest challenges that they have is because you have so many different players and the ecosystem is so complex, it becomes kind of hairy in terms of who's going to be paying, where is your first entry in terms of kind of a beachhead, and how do you really get mass adoption? So talk to us about some of the complexities as well as the opportunities in these areas.
Yeah, that is a series of very incredible, important points when you're investing in healthcare. So we very much benefit from our tenure in the industry. So really understanding the behaviors and the needs and the strategies of a lot of the large incumbent players. And they're just important players in this industry. You just can't avoid the major managed care companies. The government is a big payer here. Hospital systems are a significant force in the industry. So you have to appreciate, how they work with vendors, what their needs are to grow their business, and ultimately how they can be acquirers for the business. And, that's something that we've had experience with now for going on well over 4 decades now as an institution, with folks in the team that have been in the space for a long time. So we like these areas, value-based care. We like primary care. We like automation, as you note, because for us, it's all about the consumer patient experience. How do you deliver higher quality care? How do you drive efficiency? So you said it, a lot of these companies are kind of slower moving, have legacy technology platforms, have a lot of labor, both clinical, administrative. So what is a technology solution that can just drive efficiency in a call center or in a claims processing fashion? And, that all sounds kind of basic, but it's not. It's highly complex. These are very complicated organizations. And the dollars spent on just those 2 areas I mentioned are in the hundreds of billions of dollars. So there's plenty of market runway for a company to kind of attack these pain points.
So I want to talk about just briefly about fintech more as a metaphor for healthcare. Is that in the early days of fintech, you had a lot of naive startup founders and maybe even naive VCs that thought that some of these fintech startups would actually overtake many of the incumbent financial service providers and become the new dominant players. And of course, we have seen some of that, but for the most part, no, they've really been more of a supplier. So using that as a metaphor, in the healthcare, what are some of the areas that you've seen that's been very successful and why?
Yeah, I think it's a great point. Visa and MasterCard, they still exist, and they're still very significant players after a lot of folks with business plans thinking they would displace those entities. But on the healthcare side, the insurance companies are significant. They're bearing the financial risk for patient care. And the other factor, and some of it is just really simple to think about, we in the United States aren't conditioned to pay, think about paying for our healthcare. Even though out-of-pocket healthcare expenses are growing, employers or the government really shoulder the load of the cost of healthcare. So you just have to really kind of respect that element here. That said, there are opportunities to build improved business models in the managed care space, and certainly solutions that can help managed care better treat and manage patients. And usually the opportunities are focused on very specific patient populations, whether that's chronic kidney disease or heart disease, or, pick a major chronic condition. That's where, you can spend a lot of time as a company developing very customized solutions for that patient population, because it covers patient care, it covers the drugs, it covers mental health, nutrition. I mean, it's just a multifaceted kind of approach. And if you have kind of a purpose-built delivery mechanism, you have a purpose-built company, and you have a purpose-built technology platform around just that patient population, that's a high impact play. And the last thing I'd say is, just given how complicated this area is, just even coordinating the care. I mean, think about it. If you go to the hospital and then you get discharged, and then maybe you have physical therapy or you have home care, just coordinating all of that care in an efficient way. I mean, that creates just another big opportunity to take costs out of the system and deliver a better patient experience and ultimately a better clinical outcome. But that's really kind of our approach as we're thinking about, healthcare in general.
So you're investing into these startups that are ultimately providing these efficiencies for managed care, as well as specific diseases and specific patient demographics. But I wonder if those efficiencies at some point cascades into efficiency for the healthcare overall. You mentioned that employers and the federal government shoulders the bulk of the burn, the cost of it. We as a nation, of course, have probably the most expensive healthcare infrastructure. So are these efficiencies helping to shave some of that, or is it just turning into profit centers for some of these managed cares or insurance companies?
Well, I think so that's the beauty, I think, of like what we love about what we do every day is certainly we have investors. We're an investment firm. At the end of the day, we're generating returns as investors for our investors, but we are very much of a mission-driven organization. Like all of the portfolio companies we back, frankly, on both sides, whether it's healthcare, fintech, are really about improving the system. And so you can build a substantial value-based company but you're doing that because you have built the infrastructure, whether it's the services or the technology, to take a patient population and say, I will assume the financial risk for these individuals. And that's just making kind of better value-based decisioning. Maybe it could be a more expensive drug, but you're comfortable, prescribing that for a patient because it leads to, less downstream costs in terms of hospitalizations or treatment in an acute care setting. So there's just this value-based decision-making that ultimately is the right thing for the system. If you think about what we're operating under today, that's fee for service. Like how many, the more visits, the more money you make. Like that's just not the right thing for the US healthcare system, to your point. Like that just leads to overutilization. We're just trying to think about models, and value-based is a great example of aligning those incentives around delivering a better outcome for the right price. And, so ultimately that is going to reduce costs over time. But the last thing I would say is, it's a fool's errand, I think, to come into healthcare thinking that there's one silver bullet to solve the healthcare crisis. Like these are tens to hundreds of thousands of changes that need to be made every day, every year for the next, 100 years, in order to really address some of the fundamental issues in the healthcare system. But, you can still build a substantial company and still have impact, in even some of these pockets of the healthcare spend, because it's just so massive. And these are the types of models that are going to give us a chance to have a more sustainable system over time.
Yeah, makes perfect sense. And thank you for that. So my understanding is that you're focusing on capital efficient healthcare startups versus, let's say, biotech or new drug discovery startups that require FDA clinical trial hurdles and the heavy, CapEx and OpEx. Is that right? Or are you guys potentially shifting into looking at biotech, for example, let's say longevity, for instance?
There are a lot of excellent biotech investors out there, and it's something that was a part of the heritage of the healthcare, the starting of the Oak healthcare system with Annie in the 80s, around some of the leading life sciences companies in the country. But really over time, our expertise has evolved to focus more on services too, or software too, pharma. Healthcare service providers or managed care. And it's really part of our investment strategy. And our view is you can still play, the trends that are happening in, especially pharma through an outsourced service provider too, that's helping that drug company maybe recruit patients more efficiently, run a clinical trial more efficiently, collect information, manage the safety profile of a drug post-market. So there's a lot of services that can consumed from the development and commercialization of a drug. That's where we would play. It just wouldn't fit our profile to look at one specific molecule or drug. It just doesn't fit our investment strategy. But I love to see biotech and life sciences investors successful because those are really important drugs for the system, and an important area of the capital markets to continue investing in and developing. It's not really our focus.
Now, we're starting to see quite a bit of automation, like in wet lab. So if we think about the entire life cycle of drug development and all the things that's involved and the manual processes, so there are a lot of companies that's coming in to help automate some of those things. And some of those is certainly data and analytics, but some of it's also hardware. So where do you put boundaries around what is within your jurisdiction or area of investing versus not?
Yeah, no, great question. So we've always tried to draw the line on being more software and services oriented. And I think a great example would be like remote patient monitoring. So these are placing devices in the home that can, measure certain, behaviors or measures in the home that can be delivered back to, again, kind of a clinical services layer to see, are these individuals, doing well on a certain medication or under certain care. And that's important data back to the kind of the clinical oversight for a patient in the home. And we love home-based care because it's so less expensive than the hospital. You can do a lot of amazing things with kind of purpose-built services and these, RPM solutions in the home to provide equal, if not better care than the hospital in certain conditions. And that's, again, back to a big unlock for containing costs for the system. I mean, people want to be in their home, not the hospital for a lot of conditions. And there's a lot that can be done in the home. So RPM is a great example of like an area that's a big contributor to home-based care. But that said, like there's so much change and innovation on RPM, on remote patient monitoring. Like it's back to the drug question. For us, we want to look at a sustainable long-term model, not necessarily be in an arms race on what's the next great device. We're happy to plug that in to our clinical delivery models where, again, we're taking the financial risk for a patient. We're managing tens of thousands of patients through a primary care platform or a home-based platform. But, we don't want to be in the business of kind of picking the winner on the device side. So you would think about us as that be a plug-in, and then we like the services and the software that are powering that hardware.
Yeah, it makes perfect sense. On the RPM as well as home care, of course, we've seen a surge in that during COVID. And I wonder if you can give us other one or two examples of startups that you've invested that is doing incredible things as a result of that investment.
Yeah, well, we're super excited about a company, Dispatch. We've been invested for a long period of time. Dispatch, what's so amazing about what they're doing is, they're providing this home-based care, kind of on-demand home-based care across the country. And they're doing it in markets of all different shapes and sizes. They're doing it for all different payer types. So you can think about like for commercial insurance, employer-driven insurance, Medicare, Medicaid. So they've kind of got care models for all of these different populations, all of these different geographies. And they can also do it for a managed care company that is saying, look, you can provide hospital in the home services or acute care services or post-acute services in the home at a less cost than an institutional setting with similar, if not better quality. Like that's compelling to a managed care company. And then for a hospital system, you can say, look, I don't have capacity in my ER. There's certain patient population that, we just can't service in our bricks and mortar. This is more appropriate to do in the hospital. So let's create a joint venture and work together with a company like Dispatch that's all they do is provide high quality care in the home and organize that. And then if you go the next level down, to have that all happen on a national level, that takes a lot of clinical rigor, technology, logistics, just the onboarding and the servicing of patients. Like there's a huge amount of investments to make sure that you're delivering, again, high quality care, clinical care, but also at like a high NPS. That's something that's not measured enough in healthcare, but something certainly Dispatch focuses on quite a bit. But models like that, we love. We love treating any type of patient in their home-based setting. I think there's more to do there.
Absolutely. Couldn't agree with you more. When you look back at some of your early investments, I wonder what surprises you. For example, maybe the ones that you thought that were going to be just home runs, maybe didn't end up doing so well, or maybe there's perhaps external factors such as macroeconomics or market dynamics or just adoption and just the complexity of that plays into no matter how good that team is, the founding team is, it's not about the alpha, but it's about also the beta as well.
It is. Yeah. I think where we've fortunately worked with a lot of the best healthcare entrepreneurs in the country. And if you know this as an investor, if you're partnering with the best that have a lot of deep and relevant industry expertise, you can navigate kind of the choppy waters along the life cycle of an investment. So that's what we, first and foremost will be the quality of the entrepreneur. And so even in instances, to your point, where we have done that, where we backed great teams, but we've just had, too much friction in the business model. It's typically around just the alignment of incentives. I mean, you want to make sure, these are large stakeholders that have businesses and have ways of doing things. And I think it's where we've been trying to be too revolutionary in a model, even though it's like the right thing to do, and not appreciating that the winning strategy is making it a win-win-win for everybody. And so that's really been some of the challenge, and that gets like very nuanced in this complicated industry. But I think what we're really focused on and have been for some time is where are the friction points in the system? Like, are you a collaborator with a managed care company, or are you kind of out of the gates adversarial? And like, that's just not a winning strategy for building scale. Same thing with a hospital system, or same thing for pharma. There's plenty of opportunities to make it a win for everybody, whether you're lowering healthcare costs, you're increasing efficiency, or you're accelerating drug development timelines. Like, those are wins for everybody. And so I think that's kind of second order as we're looking at the business model. And then the third thing is, which has become even, I think, more and more important, is like having a more immediate ROI. Like, is what you're doing a nice to have, or is it a must have? It's got to be a must have to get the attention from the large kind of institutions that are buying these solutions and ultimately maybe buyers for the company. But it's also like, are you generating value in a short period of time? You don't have 10 years to show, a 2x ROI. It's got to be more immediate. And so that really pressure tests the types of solutions that we look at and ones we want to invest in.
Very well summarized. Now, going back to, let's say, 2019, I'm just talking kind of broadly at the VC markets, is that 2019 very frothy, and maybe 2020 was even frothier perhaps. But at that time, many of the VCs were pretty much all in with SPACs and IPO and really not really thinking through the fundamental valuation of some of these companies, intrinsic values, and overpaying many times. And then, of course, just a few years later, after 2021 and really the 2022 last year, we start to see not only the SPACs, but even the traditional IPOs that went public, how they soured, and many of them really been delisted in some cases, or just kind of quietly, silently have gone away. And the reason I bring this up is, undoubtedly as investors, we make hypotheses. And I wonder if there are some healthcare market hypotheses that you've made over the years where it turned out to be right, but maybe also turned out to be not so according to what you thought it was going to be.
Yeah, I'd say where we've gotten it right is we take a very long-term view. You have to take a very long-term view, particularly on the healthcare side. Like, it's a large industry, but it just doesn't move that quickly. So if you think about the cost of scaling a company, you've really got to factor in long sales cycles, making sure your technology is going to withstand all the enterprise level tests, making sure you have a team and a capitalization that's kind of built for this more methodical scaling. Now, that said, when we've seen things that have shown kind of hyper growth in the early days, it catches our attention and we jump on it because, that's would be atypical in the healthcare market, but something we've certainly seen, and we know that that's highly correlated with a successful investment. So we'll jump on those, but it's really, some of the experience we've had and just kind of what it takes to build a scale healthcare business over a long period of time. And it's just got a certain cadence to that. So that's what we've gotten right. I think if there's areas where we look back and say, gosh, I wish we would have done X, Y, and Z differently, it would have been around kind of the management team design. We're all in with the management teams we work with, but certainly, business models change, companies scale, priorities shift on where we're allocating dollars. And so, you need to be a proactive manager along with the CEO, or in support of the CEO of kind of how the ultimate management team gets formed and then evolved over time. And I'd say that's something that we're at Oak certainly far more better equipped to do. We've brought on some great folks, and we have a talent effort to support our management teams in this journey. So I think it's, again, at the end of the day, it's kind of people. We know that they're going to unlock a lot of success, and certainly our CEOs and management teams and employees do that. And so I think it's just better support on that evolution, where that's a learning from the past and something we focus on quite a bit going forward.
So on that note, I think the last several years, the healthcare industry has been tough. And of course, biotechs have even been worse, really.
Yeah.
And that's a great example. I wonder, what other ways are you helping your portfolio startups get through some of these challenges, including what's in front of us, whether you call it a recession or near recession?
Yeah, I mean, I think there's a lot of it that any investor is doing right now, and we can all read a lot about it, is like just focusing on kind of like where the most efficient dollars, where this dollar is spent most efficiently on, whether it's product prioritization or team build or growth strategies. Like, we're doing that. You mentioned kind of SPACs and IPOs and all that. Like, financing strategies are certainly something that, we, like every other investor, has had a lot of experience doing. Our management teams have only done that a couple times in their careers. And so I think that's where the experience comes into play in this market, is, kind of financing for growth, sustainable growth. I think the third thing is, it gets to the depth of our portfolios and our firm. Again, we've been in these industries for many, many decades. We have 45 active healthcare companies. We have 7 primary care businesses. We have 6 mental health care businesses. We have 2 focused on chronic kidney disease. We have 10 that are technology-driven solutions. So, I mean, just think about all the valuable crosstalk that happens amongst our portfolio company CEOs, and where we can take one experience and apply it to another. I mean, that's just invaluable when you're talking about certain customer-specific nuances that can be keys to unlocking a new account. I mean, it sounds so simple, but it's complicated, and you have to have a concentrated portfolio with a lot of depth in an area to really connect these dots in an effective way. Because ultimately, our management teams only have so many hours in the day. They're running a business, they're growing a business, they have the demands of a business. So we've got to be, have very high value interactions with our portfolio companies, and that's what we endeavor to do, pulling from all of these many experiences.
So let's say that we have the power to go back in time, and specifically to when you just co-founded Oak. What would be that one advice to yourself that you would give, that you would do differently?
I think we would have I think we would have kind of, as best we could, accelerated hiring of the team faster. I mean, because there were 3 of us that founded the firm, we were very methodical in how we've built our investment team and our firm in general with people. And so you could say, well, that's great because you're focusing on culture and you're being kind of methodical on the ads, because we take a very long-term point of view on people's careers at Oak. But there is a part of me that's, we're kind of impatient. We want to grow and have more impact faster. And so we could have accelerated our hiring. So I think that's something that, continues to be a debate. And if I rewound the clock to 2014, it certainly would have been something, could we have pushed a little bit harder on the hiring, with the goal of just being a better support for the portfolio companies as we were raising funds and backing companies. But, it's a top of mind for us every single day on making sure we're kind of most effectively supporting our companies. And so, that would be kind of one thing we could go back and look at.
Sounds great. Well, I have been joined by Andrew Adams, who's co-founder and managing partner of Oak HCFT. Thank you for joining today.
Great. Thank you, Scott.
If you've enjoyed this episode, take a moment to rate our show on any podcast platform that you listen to. Scroll down to the bottom and push 5 stars. It's that easy. And as always, thanks for listening.